Students, welcome to lecture 3 of week 12 where we have been discussing export risk and insurance. Today we will be digging deep into the topic market risk in global trade. Let us begin the journey. First, we will go through the contents of today's discussion. We will start with introduction of the topic followed by concept of market risks. After that, we will try to understand importance of market risk assessment followed by major categories of market risk. After that, we will deeply focus on price and demand fluctuation risk as well as competition, policy and tariff risk. Consequently, we will try to understand exchange rate and consumer behavior risk followed by supply chain and information gaps. After that, we will be focusing on measuring market risk and key indicators followed by strategic implications for exporters as well as contemporary global market challenges. After that, we will conclude the session. At the very outset, it is very important for us to appreciate that global trade operates in a dynamic market subject to different types of changes such as economic, social, technological, government specific, etc. The different market risk refers to potential losses arising due to adverse movement in demand, price and competitiveness. We all know that demand of goods, prices of goods and the competitiveness of markets are important indicators for businesses across borders. Thus, any risk which arise because of changes in three parameters is known as market risk. These risks affect exporters' profitability, sales stability, and long term sustainability. It is very important for an exporter to thus understand and realize the importance of market risk and adopting such strategies which can control or minimize the effects of market risk. Not only this, understanding market risk enables strategic decision making in pricing, in diversification as well as capacity planning of the exporters. Let us now focus on meaning and nature of marine risk. Of market risk. Market risk arises when external market forces affect the export performance. There may be lots of fluctuations in the market and the reasons may be due to changes in international prices and cost of production, due to consumer preferences and demand patterns. As we know that preferences of the consumer changes from time to time, thus any changes in consumer preferences also generate different types of risk. The third is competitive structures and substitute products. The competitive structure of a market is very important. For example, if a market from monopoly is getting converted into monopolistic, then the current exporters will face huge competition because new players will be allowed to enter into the market. Thus, the competitive structures of the countries where exporters are exporting is very important. In addition to that, we also have trade barriers, tariffs and policy shifts which also create market risk. As there may be substantial changes in the tariff rates between two countries, these are also the risk which can emerge anytime. We have a very good example of tariff barriers such as the trade war between USA and China. We know that the tariffs have been imposed by United States of America on Chinese goods, and in retaliation China has also imposed tariffs on United States of American goods. So this kind of things generates lots of risk, and the exporter should know the strategic decision making in such circumstances. Thus market risk is systemic, cannot be eliminated but can be anticipated. Thus, we cannot say that any market risk can be equal to zero, but it will always remain positive that some level of impact will always be there. But what an exporter can do is exporter can use strategies to mitigate or minimize the market risk by proper planning and execution of such decisions. Let us now try to understand the importance of market risk assessment, that is identifying the market risk. The first importance is to determine viability of foreign market entry or continuation. With the determination of market risk, an exporter can identify whether they should enter any new market or not, or whether where they are today operating they should continue their operations or not. The second importance of market risk assessment is which assists in pricing, hedging and marketing decisions. So pricing is one of the factors based on which the consumers decide about their choices of purchasing the product. Similarly, market strategy is also done based on consumer preferences. So as consumer preferences are part of market risk, any changes in consumer preferences need to be substantiated by changes in pricing and marketing strategies. The third importance of market risk assessment is that it reduces vulnerability to sudden shocks in demand or cost. The immediate changes in demand or cost increase the vulnerability of the exports or of the products. It can be minimized through understanding proactively the market risk. Similarly, the next, that is fourth importance, is market risk assessment supports negotiation of stable long term contracts. Long term contracts are very important because with long term contracts there can be lots of negotiation and there can be agreement on certain things including prices and consumer preferences. This can provide stability in the decision making of the business for a long period of time. The fifth and the last importance of market risk assessment is that it strengthens exporters' adaptability to changing, that is dynamic global condition. We all know that global trade works in a fluid economics. That is, it is the environment is always dynamic and changing. Thus, market risk assessment helps exporters to change their policies and decision based on the dynamic changes. Let us now try to focus on major categories of market risk. This helps an exporter to determine the exact issue with any type of risk. The first is the price risk, which is because of volatility in international prices. At the international level, that is global markets, commodity prices change very frequently, and that is known as volatility in international commodity or product prices. These changes in prices may be due to some country specific issues or firm specific issues. But whatever the cause may be, these creates lots of fluctuation in the prices which may affect the profitability of the exporter. The second category of risk is the demand risk. Changes in consumer preferences, changes in the income level of the consumers, as well as other factors such as weather, technological preferences, etc., may change the demand of the product in terms of the consumer's need. Such, therefore, the buyer's preference may keep on changing, and this is also an important category of market risk. The third type is the competition risk which arises due to presence of competitors and other players. There may be entry of some high quality producers or low cost producers which may challenge the existing exporters. Thus, these are also considered to be market risk. The fourth type of market risk is policy and tariff risk. These are because of changes in the policies by the home or the host country governments, as well as changes in tariff rates by different countries. At times it happens that two countries have some kind of dispute, and because of which tariff rates have been increased by one country, and then in retaliation other country is also increasing the tariff rates. This causes more dispute and hampers the smooth facilitation of trade. Thus, for exporters, this is also an important category of market risk to be controlled and assessed. The next type of market risk is exchange rate linked market risk. We know that international trade, export and import involves foreign exchange and currency movement across the border. Thus, the currency movement and foreign exchange also affects the pricing competitiveness of the exporter. Thus, this is also a type of marketing risk, a type of market risk. And finally, the last category E is socio-economic and consumer behavior risk. This is due to shift in economic conditions, that is income, culture or lifestyle of the people, and they may change the perspective of using a particular product, which may ultimately result in low demand of the product, and that is also a market risk for exporter. Let us now try to understand the price volatility and export performance means. What is the link between these two? Prices of internationally traded goods fluctuate, which is known as volatility. This may be due to several reasons. One of the reasons is the commodity cycles and global supply demand gaps. Globally, we can see there may sometimes be the gap between demand and supply of goods at the international market, and these gaps may result in changes and in the international prices, which may be positively utilized by the exporter or may sometimes hamper the pricing competitiveness of the exporter. The second is the input cost inflation and freight variation. These are also some changes in prices of the product, and that also has a negative impact on exporters. And third is the speculative trading and exchange rate movements, that is trading by holding of the goods, foreign exchange, etc., in the anticipation of more profits in the future, or vice versa, can also result into the price volatility, and that also has mixed response towards the export performance. Now, what are the impacts of these changes? The first is uncertain revenue realization. Due to these frequent price volatility changes, what will be the exact revenue that will be realized is a problematic issue. The second becomes difficulty in long-term contract pricing, because if price volatility is very high, which means prices are changing very frequently, then there cannot be a very specified price deal between exporter and importer for a long period of time. Thus, there can be more number of short contracts, but we will see that there will be very less number of long standing contracts between exporters and importers, that ultimately affects the trust between exporter and importer. And the third one, which is an important impact, is the inventory value loss when price fall post shipment. So the goods have left to the destination and already 1 month has passed, but once the goods reach the destination, the prices in the destination markets have gone down, or in the international market they have gone down. Now the importer is ready to pay the price only at the current level of the price. Now this is going to be a burden on the exporter. So this is also an issue which remains an issue of concern for the exporters, which reduces the export performance in terms of profitability and valuation. Let us now focus on the demand side risks in terms of market risk. The demand is influenced by global economic growth, income levels, and consumer preferences. Risks include, which are demand side risks, the recession or slowdown and in importing economies, that is the destination of the goods economies. Similarly, rapid technological obsolescence, the technology is every day becoming obsolete and new technologies are replacing, so the goods with the old technology becomes old goods and become outdated goods. Similarly, the seasonal or cyclical consumption pattern. Seasonal patterns means, for example, demand in summers for winter clothing goes down, and cyclical consumption pattern also happens like in fashion industry. Things become old, then again they resurface in the fashion industry. And the third is non-tariff barriers reducing product acceptance. Different non-tariff barriers such as quality concerns, such as sanitary and phytosanitary measures, etc., also are the demand side risk. So the demand side risk ultimately leads to unsold inventory or forced discounting, where the exporter has to sell the goods because they have already reached the destination on low prices. Otherwise, the cost of bringing back those goods is much higher. Let us now try to identify the competition and substitution risk. We all know that globalization intensifies rivalry among the producers across country. It is also known as global rivalry theory, and strategic where strategic decision making becomes very important. So the emerging market exporters often face several types of risk which fall under competition on and substitution risk, such as low cost competition among regional clusters. So the competition is about offering lower cost, and lower cost does not be converted into higher profitability. Then brand displacement by multinationals, and finally substitution through innovation or new materials. Thus, we can easily understand under competition and substitution risk that sustaining competitiveness demands differentiation, innovation, and quality consistency. Let us now try to understand policy, tariff, and trade barriers risk. Exporters face uncertainty from tariff hikes or safeguard duties. Similarly, they also include the anti dumping measures or quota restrictions. These risks also include sudden changes in preferential trade agreements, such as the generalized system of preferences, foreign trade agreements, free trade agreements, etc. Similarly, sanctions and embargoes on specific regions, for example, United States of America has put sanctions on Russian Federation, on Iran, Cuba, etc., that is also coming under the tariff and non-tariff barriers. These all types of risks are instantly altering the market access and profitability of the exporters. Thus, these are very important to be strategized by the exporters in terms of decision making. Let us now try to focus on exchange rate and market competitiveness. What is the relationship between these two? The currency fluctuations affect export price parity, and in line with that, appreciation of exporters' currency reduce the price competitiveness. On the other hand, depreciation of the importer's currency higher local cost for buyer. Thus, it is very important to understand that what is the impact of exchange rate on market competitiveness. Similarly, persistent volatility means if the currency exchange rate is changing very frequently, this also affects the order value, volumes and the margin of safety as well as profit. Thus, there can be several ways in which exchange rate and market competitiveness can be balanced. We can have forward contracts in exchange rate as well as hedging that can stabilize the pricing, which we will be discussing under the future slides. Let us now try to identify the socio-economic and consumer behavior risks. These include shifting lifestyle, cultural values, or demographic trends that changes the demand of the product. Examples include rising eco-consciousness of the product, that is environmentally friendly products, and less use of non-sustainable goods. We also have an example of pandemic led consumption, which can alter the consumer behaviors and which can be unpredictable in their demands as well. Thus, exporters must continuously track cultural and social dynamics in the target markets. Let us now try to explore supply chain and logistics relationship which can link market risks together. Market access is sometimes disrupted by port congestion, freight cost, and container shortages, which are part of the supply chain and logistics. There can also be the geopolitical conflicts which affect trade route. For example, if there is a conflict between China and Japan, there can be conflict in the South Sea in the Arabian Ocean. Then we can also have disruption of raw material supply networks. For example, recently the rare earth minerals which are being exported from China were not allowed to enter certain countries. So these all are the examples that are associated with market risk, but they specifically deal with supply chain or logistics issue. All these type of risks indirectly raise landed cost, that is cost of landing the goods, and affect price competitiveness of the exporter. Similarly, these integrated logistics planning reduces exposure to supply chain shocks as well. Let us now focus on information and intelligence gaps as market risk. These are the inadequate or outdated market intelligence which can lead to wrong type of decisions. Thus, information is very critical. As we say that information asymmetry always raises the margins, it is very important for exporters to understand information in a positive manner. Thus, lack of reliable data on prices, on tariffs, on consumer preferences increases the probability of bad decisions and exposure to losses. So, for small exporters, they often depend on intermediaries for decision making, magnifying uncertainty. Thus, they need to use more properly the trade statistics and trade data. They can use, and anybody else can also use, the institutional sources which provide free data related to trade. The DGFT, Directorate Journal of Foreign Trade, International Trade Center, the trade map is there. Export promotion councils in different countries help with specific commodities and areas. All these can minimize the market risk through intelligence and information mechanism. Let us now try to understand the measurement and indicators of market risk. There are different quantitative tools that can be used by exporters, such as price volatility index, which measures fluctuations in commodity or product prices. The second is demand elasticity analysis, where the responsive change in demand of the product with respect to changes in prices can be identified. The third is country and sector specific ratings by different agencies. Then we have market concentration ratios, which tells about how much concentrated an international market or a country specific market is. For example, HHI index is used, which is very popular. There can also be qualitative indicators such as policy stability, ease of doing business, and buyer concentration. Thus, if these risks are understood properly by the exporters, the regular risk scoring can support portfolio diversification of the exporters, which can further increase the profitability of the exporters. Dear students, let us now focus on strategic implications of market risk. Market risk affects exports planning, marketing, and investment decisions. The second important thing is the influences product diversification and regional expansion. The third strategic implication is that it requires dynamic costing and flexible pricing mechanism. And finally, it also impacts the credit and insurance eligibility, as well as they also are very important for small and medium enterprise because their concerns are a bit different. Let us now try to focus on institutional and government supports. Exporters can utilize the export promotion councils which are present in their own countries and different other regions for market support in understanding market through market risk, as well as identifying the possible and probable types of risk. They can also utilize different trade missions, trade fairs, exhibitions for exploring the demand of their products. They can also use the DGFT, that is Directorate Journal of Foreign Trade scheme, which promotes diversification among the exporters. They can use the ECGC for coverage against buyer and country risk. All these institutional frameworks can lower information and payment related uncertainties. Let us now try to see the contemporary, that is modern sources of market risk. Global events in the modern time are reshaping how market risks are seen. So we have, for example, the first one, supply chain realignment post pandemics. Number two, the digital disruption because of new technology and e-commerce, that is electronics commerce competition that is emerging because of Internet of Things. The third is the energy transition altering demand for traditional commodities. And finally, fourth one is the protectionist trends and friend shoring strategies. So some countries have started protecting their own territories. And for example, United States of America has a policy of America first, trying to block the Chinese goods in USA. And fifth point and the last one is the ESG compliance is also a new phenomena, like that is environment, social and governance concerns. We can take an illustrative example to understand the market risk scenario. Scenario is an Indian exporter of leather goods faces sudden European Union regulation banning the chromium based tanning. So this is a challenge that an Indian exporter is exporting leather, but according to European Union's changes in regulation, they are now banning the chromium based tanning. So what will be the impact? The product becomes non-compliant, orders will be cancelled, prices of the same thing will drop because now they are not allowed. What is the key learning? The regulatory shifts create market risk beyond price or demand. What should be the response? Innovation, so that they should change the process and tanning should now be chromium free. So they have to move from one production process, they have to innovate, and process adaptation is essential for market realization and resilience. Dear students, it is time for us to conclude whatever we have discussed in today's session. We have discussed and identified that market risk stem from economic, policy and behavioral volatility in global market. We have also learned that market risks affect pricing, demand, competitiveness, and long-term export stability. It is also to be added that market risk cannot be eliminated to zero but can be anticipated through research, flexibility, and diversification. Thus, understanding market dynamics is prerequisite to designing mitigation strategies for the exporters. And finally, continuous monitoring and intelligence are key to sustainable export performance. Dear students, thank you very much for being with me in this session.